It's 12:01, so I'll just get started with the introduction so we give Professor Hoyt as much time to present. Okay, welcome everybody. Today is a special Hawaii State Planning Council meeting that we have this month. I would like to welcome our special guest today with Hawaii Community Foundation and Hawaii Gift Planning Council. So this is set up as a webinar, a little bit different from what we're used to every month, but we're happy to have everybody joining us today. We do have CE credits available today. So we have for attorneys, we have for CPAs and CFPs, as well as CFREs. So if you indicated when you RSVP'd that you want CE credit, then we will contact you regarding your credit. If you did not include any indication that you wanted credit and you're a Hawaii State Planning Council member, feel free to contact either myself or Nick or Matt, as you normally would every month for CE credit, which is in the email that goes out to all of you. If you have any questions regarding your CFRE credit, it has been approved, but you can also contact Christy Bates for that. Okay, so today we are honored to have Hawaii Community Foundation sponsor today's speaker, Professor Christopher Hoyt from the University of Missouri, Kansas City School of Law. And to introduce Professor Hoyt, we have Janelle Lyman, Director of Plan Giving and Advisor Relations. Janelle.
Mahalo, Jennifer, and mahalo to Hawaii State Planning Council for the opportunity to sponsor today's presentation. You know, I have no doubt that those of you listening today will have a few aha moments from Professor Hoyt's presentation and materials. So a few housekeeping notes before we start. Professor Hoyt will answer as many questions as he can throughout the presentation. So please feel free to use the chat box at the bottom of your screen to ask away. Today's presentation is being recorded. Next week, we will send you an email with a copy of the recording, the PowerPoint slides, and a white paper from Professor Hoyt. You know, today we have the honor and privilege to sponsor Professor Hoyt to share with you tax-smart charitable giving strategies to help you and your clients. Professor Hoyt teaches courses at the University of Missouri, Kansas City School of Law in the areas of federal taxation, business organization, retirement plans, and tax-exempt organizations. He is currently the chair of the American Bar Association's Committee on Lifetime and Testamentary Charitable Gift Planning and serves on the editorial board of Trust and Estates magazine. Equally as impressive is the fact that Professor Hoyt is a frequent speaker at legal and educational programs and has been quoted in numerous publications, including the Wall Street Journal, Forbes, Money Magazine, and the Washington Post. Professor Hoyt last visited Hawaii in 2016 and attended the 75th anniversary ceremony for Pearl Harbor. Hopefully, we'll have him the opportunity to come to Hawaii so we can see him speak live and in person. But until then, we are honored to have him speak virtually today about tax-smart charitable giving, especially with retirement assets.
Mahalo. Mahalo, Janelle. Thank you. And aloha to our friends. And I hope each of you who's participating is in good health and your families are healthy. And on a personal note, I'm pleased to report that this morning I passed the COVID test. Well, just the written part. I still have to take the other part. So I'm sure you're all dressed better than on the mainland here. We wear these ties because it keeps our shirts up. At least that's what I'm told is happening. So let's get started. We're going to be spending about 55 minutes here. Tax smart charitable giving, especially with retirement assets. And by way of background, every charitable gift has a cost. But if you structure it right, making the charitable gift will reduce your tax liability. And so therefore, what we're going to try to do is structure the gifts in such a way that it has the lowest after-tax cost to us. Because every dollar that's not spent in taxes is a dollar that's available for the family or for the charitable organization. So we're going to cover four things. First, we're going to talk about why is it harder to get tax benefits today than it was 5 years ago. There are fewer deductible charitable gifts after the 2017 Tax Cut and Jobs Act. So once we understand why there's a problem, we're going to look at two strategies that produce tax savings for the charitable gifts. And the first is donor advised funds, of taking several years of charitable gifts and deducting it in 1 year. And you can do that very effectively with donor advised fund, such as at the Hawaii Community Foundation. But the other strategy, which is if you have donors who are over the age of 70 and a half, they don't need donor advised funds, because if those donors have an IRA, an individual retirement plan account, that IRA can become their charitable foundation. So those are the two strategies we're going to use for living donors. And the last thing we'll talk about is this idea that when a person has a retirement plan account, like an IRA or a 401k plan, under the new law, you have to liquidate that within 10 years of death. But can we instead leave that IRA to a charitable remainder trust that will provide income to your children for the rest of their lives, not just 10 years, but the rest of their lives? And when will that provide tax savings? So those are the four topics we're going to cover in the next 50 minutes. So very briefly, a summary of the new tax changes, the CARES Act. And the first thing is, normally to get a charitable tax deduction, you have to itemize your deductions. But last year and this year, if you make cash gifts, you can deduct those cash gifts even if you don't itemize, even if you take the standard deduction. Last year it was $300, and this year, 2021, it's also up to $300 of cash. But for married taxpayers on a joint return, they can deduct up to $600. There's an annual deduction limitation. There's only a certain percent of your income that you can deduct for charitable gifts. Normally it's 60% for cash gifts, but this year you can actually deduct up to 100% of your income when you make cash gifts. Now, certain charities don't qualify for these deductions. Some money to donor advised funds, to supporting organizations, SO, the Friends of the Hospital, and to private foundations are not eligible. And finally, corporations have a limit on how much they can deduct. A corporation that pays a corporate income tax, subchapter C corporation, not subchapter S, the most they can normally deduct is 10% of their income. This year, they can deduct 25% of their income. But let's start with the challenge of getting tax breaks from charitable gifts, how it is harder to do it now than it was 5 years ago. And basically, how do you get a tax benefit from a charitable gift? And except for the $300 and $600 rules we have this year, to get a charitable gift, you have to itemize your deductions. That means you don't take the standard deduction. And the itemized deductions are your mortgage interest on your home, your state and local taxes, Hawaii taxes, income taxes, and your charitable gifts. And you add that up, and is that more or less than the standard deduction? Well, in 2017, they doubled the standard deduction to $12,000 single and $24,000 married. But the biggest hit was the most that you can deduct for your state and local taxes is $10,000. So that if you pay $50,000 in income taxes to Hawaii, you can only deduct $10,000. So the number of taxpayers who deducted charitable gifts fell from 33 million tax returns in 2017 to just 12 million tax returns in 2018. And that's mainly because of the limitation on your ability to deduct Hawaii income taxes. So we now have a Democratic House, a Democratic Senate, and a Democratic White House. And people from New York and California and Connecticut are really pressuring to change that law. So will Congress eliminate the $10,000 SALT limit? And what we're seeing is a proposal to raise it to $20,000. We're not seeing an unlimited deduction for the charitable giving. So my message to the charities is, first of all, we still have 11% who deduct their charitable gifts. 11% of tax returns itemized. And we can still say, make your tax deductible gift, even though there's only 11% who itemize instead of 30%. But the first strategy we're going to talk about is bunching your gifts. And you need capital for that. You know, you make your gifts from, instead of making from income, you make your gifts from stock or mutual funds or ETFs. You have something that you can contribute to charity. And so if you're used to giving away $10,000 a year to a charity, this year, contribute $40,000. But if you give that to the charity and say, thank you for that big gift this year, and you say, well, leave me alone for a few years. Well, the easiest way to do this is a donor advised fund. So that if you normally give away $10,000 a year, you could put $40,000 this year into a donor advised fund, take a tax deduction for $40,000. And then every year the donor advised fund makes the grants to the charities, and they don't notice any different in your giving pattern. That said, again, for those donors who are over the age of 70 and a half, they don't need a donor advised fund, because if they have an IRA, an individual retirement account, not a 401k plan, not a 403b plan, it has to be an IRA. If they have an IRA, they can use their IRA like a charitable foundation and just give money away to charity. We're going to go through those rules in a minute. So donor advised funds, bunching tax deductions into tax years. So for example, I've been using this example. We have a married couple that every year contribute $10,000 a year to charities. But with the $10,000 SALT limitation, they have no mortgage interest. So they give $10,000 to charity. They have $20,000 of state and local taxes. Their itemized deductions are $20,000. 10,000 state and local taxes, 10,000 charitable. Well, the standard deduction for married couple is $24,000. So they can deduct $24,000 whether they give $10,000 to charity or nothing to charity. They get the standard deduction of $24,000. So they get no tax benefit from the charitable gifts. So the idea is this year they'll put $40,000 into a donor advised fund. Tip: use appreciated stock. Use stock that's gone up in value. Use a ETF. Use a mutual fund that's gone up in value, because you can deduct the $40,000 value and never pay tax on that growth in value. So again, the best thing to put into a donor advised fund is appreciated stock, appreciated ETFs, appreciated mutual funds. Well, now with a $40,000 charitable gift and $10,000 state and local taxes, then now this year the itemized deductions are $50,000, and they can itemize their deductions. And now the donor advised fund makes grants of $10,000 a year to their favorite charities over the next 4 years. So donor advised fund is a fund or an account owned by a sponsoring public charity, where the donor or a person appointed by the donor can recommend grants or investments. And they just say, I recommend a grant to, University of Hawaii, I recommend a grant to the Boys and Girls Club, whatever it is. And then the donor advised fund makes those distributions. They have lower administrative costs than your own private foundation. They can make grants to any public charity, including the mainland, where some people wear ties to hold their shirts up. And they're very popular. Grants from donor advised funds already exceed 40% of the grants made by private foundations. So who offers these donor advised funds? And clearly the Hawaii Community Foundation does. And then we have the national donor advised funds, Fidelity, Schwab, Vanguard, Goldman Sachs, the brokerage houses will have them. And then national charities like the National Christian Foundation, and some universities like Harvard University has donor advised funds at Harvard. We can see that in terms of new donor advised funds, the national funds, Schwab, Fidelity, Vanguard, have close to 20,000 new funds, versus the community foundations are the green slice. And so that's kind of how the money is divvied up. In terms of donor advised funds, they're huge. There were 729,000 donor advised funds in 2018. This is the report from the National Philanthropic Trust. They held $121 billion in assets. But by comparison, private foundations, there's only, there are 10 times as many donor advised funds as there are private foundations. There are 80,000 private foundations that make grants, but they have $873 billion. They have 7 times as much money as the donor advised funds. But it's kind of like the country, the richest 1% of private foundations have 60% of all the private foundation assets, the Bill and Melinda Gates Foundation and the like. $37 billion was put into donor advised funds, but donor advised funds are like checking accounts. $3 billion was distributed. By comparison with private foundations, even though there's 7 times as much money, they don't give away 7 times as much money as donor advised funds. They only give away $54 billion because they tend to be endowed with investment income and give away just 5% of their assets. Now you can see the explosion in donor advised funds triggered by this tax law, triggered by this bunching of gifts. In 2015 and 2016, there were about 300,000 donor advised funds. It went up to 463,000 in 2017, 730,000 in 2018, and it's just everybody's catching the idea. So most donor advised funds are less than 5 years old. People are just beginning to use them. Now, because it's pretty easy to set up a donor advised fund and doesn't require much money, $10,000, $20,000, a lot of people are setting these things up with a bunching idea. And so the average balance in the donor advised fund has gone down in 2018. And I do want to take credit for this, that I and my family single-handedly reduced the average size of donor advised funds. I did set up a donor advised fund in 2017 to get the tax deduction. Donor advised funds now receive 10% of all charitable dollars given away in the United States. And for tax planning, it makes a lot more sense when you can get a tax benefit that way that you can't get with the normal giving. So that's the first strategy, is set up a donor advised fund and do it with appreciated stock, appreciated mutual funds, appreciated ETFs to get the double benefit of the tax deduction for the value of the stock, mutual fund or ETF, and never paying tax on that growth in value. Though for the donors over the age of 70.5, we can tell them you don't need a donor advised fund. As long as you give away less than $100,000 a year to charity, you can have a qualified charitable distribution from your IRA. And your IRA can be your charitable foundation. And it's so cheap. And I'm going to show you the easiest way to run these things. So we're going to run through the advantages, but I do want to warn you about a tax trap where people will not be able to use their IRAs for charitable giving. And I'm going to show you the solution. And let me just tell you what the problem is. The problem is if after you're retired, you have a tax deduction for putting money into an IRA, then for the rest of your life, you will not be able to exclude all of your IRA gifts. And I'll show you how the numbers work. So if you have a client over the age of 70.5, I just told you that for donor advised funds, use appreciated stock, appreciated mutual funds, appreciated ETFs. But if they're over the age of 7.5, the IRA is better than appreciated stock or appreciated mutual funds or ETF. The IRA is better. And most donors over the age of 7.5 should make all of their charitable gifts from their IRAs. And these are called qualified charitable distributions. So the law is now permanent. And so when you have a check go from an IRA, I'm going to have an example of a man or a woman who gives $4,000 to a charity. As the $4,000 check goes from the IRA to the charity, they will not have to report that $4,000 as taxable income. And so all the seniors who don't itemize can use their IRAs for charitable giving. They'll get the tax benefit that the $4,000 that would have been taxable to them instead will not be taxable to them. Now, they won't be able to take an income tax deduction, an itemized deduction for the $4,000 gift, but who cares? Because it's hard to itemize your deductions anyway, and the real benefit is to reduce your taxable income compared to qualify for an itemized deduction. So here's an example, a donor at the age of 75, and this donor has to take out $10,000 this year. So once you're over the age of 72, you have to take out a minimum distribution. In your 70s, you take out between 4 and 5%. In your 80s, you take out between 5 and 8% every year. Every year, the percent you have to take out goes up a little bit. So donor age 75 has a $10,000 required minimum distribution. And if you don't take out the $10,000, by the way, there's a 50% penalty. So if the person doesn't take any money out, the IRS will take $5,000. So you want to comply with this law. So this donor says, issue a check to a charity for $4,000, issue a check to me for $6,000. $10,000 leaves the IRA, $4,000 to the charity, $6,000 to the donor. So the way this works is on the line for IRA distributions, line 15 here, there's a line that says IRA distributions $10,000. And when the donor gets the notice from the IRA administrator, the IRA administrator doesn't care whether the money went to a charity, or with family member. They just say all $10,000 will be taxed to you. So the IRA administrators don't look at charitable gifts. Why not? Well, because we don't want the IRA administrators to have the burden of saying, well, that's a charity, but that's not. Did the charity give you something in return? You know, is this like your child's tuition? They want the burden to be on the IRA owner. So the IRA administrator just says $10,000 was distributed. But then what the IRA owner does in the tax return is in box 15A, they say $10,000 distribution. And the IRS computer says, okay, good. This person took out the minimum distribution. There's no 50% penalty. And then on the taxable amount, we only put in the $6,000. And then to explain why you're not paying tax on all $10,000, on your tax return, you write 3 letters, QCD, Qualified Charitable Distribution. And that way, you're telling the IRS why you're not paying tax on all $10,000. The other $4,000 went to a charity. Now, there was a question posted here, and we'll get to SEPs in a second. There was a question posted here about what if a donor was going to make a charitable gift from the IRA, but they died before they could? Can the IRA make the distribution to the charity? Let me get back to a more basic principle, and then I'm going to answer that question. When we have second marriages, blended families, sometimes the IRA beneficiary will be one person, but the beneficiary of the probate estate will be another person. You know, it might be a child from the prior marriage gets the IRA distribution, and then the probate estate goes to the second spouse or something like that. So the rule is this: what happens if somebody was supposed to take out $20,000? That was the minimum required distribution. And when they die, the probate estate goes to like the second family. And the IRA is payable to the first family, and then they die. Clearly, if they'd taken out the $20,000, that would be assets in the probate estate, and that would go to that family. But the best way to think about this is your IRA is a trust under Hawaiian law. Now, if it's not a trust under Hawaiian law, it's called a custodial account that operates like a trust. But let's just apply trust law. If a trust says, while I'm alive, pay me this money. When I die, the trust proceeds go to so-and-so, kids from the first marriage. Well, in that case, the kids from the first marriage will get the money, even though the person was supposed to take out $20,000 and would have gone to the people in the second marriage. It goes to the people from the first marriage. And so the answer is no. If they wanted to make a QCD while they're alive, the IRA says upon my death, it goes to so-and-so. You cannot make a gift to any beneficiary other than the beneficiary on that form. We'll get to SEP IRAs in a second here. There's another question. So to qualify for this, you have to be over the age of 70 and a half. The most you can do is $100,000. If you could take out more to give to a charity, but they don't have to report as taxable income and try to itemize it. But the secret sauce here is that the charitable gift satisfies the required minimum distribution requirements. And now there's other stuff you cannot do with an RMD. For example, if you have to take out $10,000, you can't do a Roth conversion of that. You have to take $10,000 and put it in a checking account and then do a Roth conversion with other money. You can't roll over the $10,000 into an IRA. The one thing you can do with a required distribution is give it to charity. So obviously it's a pain to have a separate check. You should only do this if you save taxes. And who saves taxes? And the answer is donors who do not itemize their deductions, which is more than 90% of the seniors because they don't have any home mortgage interest. So if they take the standard deduction, they should use their IRA for all charitable gifts. In some states like Ohio and Indiana, there's a problem. I don't think it's a problem in Hawaii. The third situation is as your income goes up, your tax breaks go down. Social Security benefits become taxable. And if you want to hear a senior citizen complain, I'll just sit next to them for a few minutes. But if you want to hear them really complain, they'll talk about Medicare B premiums, Because if your income is just $1 over 87,000 single, about 170,000 married, your Medicare B premiums go up 40%. Well, if your charitable IRA distributions can get your income under 87 grand single or 170 grand married, then your Medicare B premiums are the lowest they can be. And finally, remember I said, oh, give appreciated stock. And I said, this is better than appreciated stock. Why? Well, these donors are over the age of 7.5, okay? Their life expectancy is less than when they were in their 20s and 30s. And so if they have $100,000 in an IRA and they have $100,000 of stock with a basis of $20,000, what happens when they die to the tax basis of the stock? Well, it's a step up in basis. When the kids inherit the stock, they'll have a stock with a basis of $100,000. But what happens if we leave the kids the IRA? Well, they have $100,000 of taxable income. So the last people who like this are the heirs, because that's why they should give to the charity from the IRA and not give the appreciated stock, because that's going to provide an income tax to the beneficiaries who will not have taxable income, but they'll have stock with a step up in basis. So there are 7 legal requirements, and just in the interest of time, first of all, you have to be over the age of 70 and a half. Now, you know that the new age for required distributions is 72. And there's a bill going through Congress that's very likely to pass that will even raise the age of 75. You don't have to take money out of an IRA till you're 75, but right now it's 72. Well, for charitable gifts, they kept the old law of 70.5. So if someone this year is age 71, they can use their IRA for charitable giving. Second, it has to come from an IRA. It cannot come from a 403B plan of a professor. It cannot come from a 401k plan. So if somebody has a 403B plan in their 70s or a 401k plan and they don't have any IRAs, just roll some money over into an IRA and use that for your charitable giving. Third, the statute says that the grant has to be made directly from the IRA to the charity. And what that means is that the charity's name is on the check issued by the IRA. A lot of people think, I'm going to take this distribution from an IRA of $10,000, put it in my checking account, write a $10,000 check, clear the money. The source of the money was my IRA. Won't work because the check was not issued in the name of the IRA. Now, the best way to administer this law are what we call IRA checkbooks. And these are offered at brokerage houses: Merrill Lynch, Smith Barney, Raymond James, Fidelity, Vanguard, TD Ameritrade. So at Fidelity, if you're over the age of 70 and a half, and I'm not talking donor advised funds here, I'm talking IRAs. If you're over the age of 70 and a half, Fidelity and all these other people will give you a checkbook where every check you write is a distribution from your IRA to the grocery store, to your kids. Because that frees the IRA administrators from, pick up the phone. I want to check issue my kid. I want to check issue the grocery store, whatever it's going to be. They'll give you these IRA checkbooks. So it's very dangerous. Every distribution is taxable income. But these things are fantastic for administering this charitable IRA law. Because when the senior citizen goes to the accountant, gives them their receipts from the charities and their shoebox, thank you for your gift of this or that. The charities don't say that was from the IRA, just say thank you for your gift of $500 or $300. And the accountant doesn't know which of these were from the checkbook, which of these from the IRAs. But if you have one of these IRA checkbooks where every distribution is from the IRA, well, then you just give that to the accountant and they can go through the check register and they're going to get the 1099-Rs and see how much taxable distributions they were. And then they can look at the IRA checkbook and see how much of those were to the charities. So these IRA checkbooks are the best way to operate this law and make sure that you don't have any mistakes where charitable gifts were made by the IRA, but were deducted as itemized deductions instead of going through the IRA procedure. You have to really write checks to charities, and we won't go through all the technical rules. And every public charity is eligible, and also a private operating foundation like a library and the like. And here's a question: can QCDs be made from profit sharing 401k plans? No, they have to be individual retirement accounts. But a donor advised fund cannot get these IRA gifts, and a supporting org like the Friends of the Hospital cannot. The fifth requirement is that this has to be 100% charitable. There can't be any personal benefit to the donor that would reduce the charitable income tax deduction. So if you're buying tickets for a fundraising dinner and there's a meal, you're buying a charitable gift annuity, that's what CGA is. You're buying better seats at the football game. And by the question I just asked earlier, and by the way, right now, tickets to football games no longer qualify for charitable deduction. Until 2017, you could deduct 80% of what you paid for better seats, but now you can't deduct anything. And the question I asked, I work at the University of Missouri, how can you keep University of Kansas students out of your backyard? Answer, paint it to look like an end zone. And then your problem solved, that they'll never get in there. All right, let's skip the last one. The last thing is the donor, the IRA account owner, has to have a letter from the charity that the donor received no goods or services. There was no personal benefit. Some technical rules. Yes, you can use your IRA to satisfy a legally binding pledge. Private foundations have a problem with that, but no, you can say, I made a pledge to the university, I'm having it paid out of my IRA. On a joint tax return, each spouse can take up to $100,000. So on a joint return, it can be $200,000. But you can't take like 150 out of one, 50 out of the other, maximum 100. When you take a distribution from an IRA, they say, how much taxes do you want to have withheld? With the checks to charities, say 0. And then I get this question, like somebody's 58 years old, and they say, my mom died at age 88. I got her IRA. My mom, who was 88, was using her IRA for charitable gifts. Can I take the inherited IRA and make charitable gifts? And the IRS says that if the beneficiary, the son, is over the age of 70 and a half, you can use an inherited IRA for charitable gifts, but the son's only 58. By comparison, a brother or sister who's in their 70s gets the IRA, they can do it. Now, here's the tax trap. If you want to make a charitable gift from your IRA in the future, a QCD, a qualified charitable distribution, then if you ever plan for the rest of your life to ever use your IRA for charitable giving, then you should never make a tax-deductible contribution to your IRA after the age of 70 and a half. Now, what happened was, it used to be that if you're over the age of 70 and a half, even if you're still working, you could not take a tax deduction for a contribution to an IRA. But the Secure Act opened that up. If you're still working in your 70s and 80s, employed taxpayers over age 70 and a half are permitted to make tax-deductible contributions to the traditional IRA. It's $7,000 if you're over the age of 50, and so clearly they can do that. The problem is, if such a person who's still working in their 70s and 80s ever makes a tax-deductible contribution to IRA after age 70 and a half, then the amount of the qualified charitable distribution from IRA that can be excluded from taxable income is reduced dollar for dollar for every dollar they deducted for the rest of their lives. I'm going to come, might be going a little fast, but I'm going to come back to this. Now, here's a statute. I'm going to show you. It says the amount of distributions to charities that are not includable in gross income by reason of the preceding sentence for a taxable year shall be reduced by an amount equal to the excess of the aggregate amount of deductions allowed to the taxpayer under Section 219. I'm going to repeat Section 219, Section 219. I'll show you a loophole in a minute. The aggregate amount of deductions allowed to the taxpayer under Section 219 for all taxable years ending on or after the date the taxpayer attains age 70 and a half. So if someone at age 71, 72, 73 puts in $7,000, that's $21,000. Then for the rest of their life, the first $21,000 that leaves the IRA will not qualify for this tax benefit. Now, what's going on? Well, to get a tax benefit for a charitable gift, normally a taxpayer has to itemize their deductions: state and local taxes, mortgage interest, charitable gifts. But only 11% of taxpayers itemize. And the seniors have paid off their home mortgage. So they have an idea. I have an idea. I'll have $7,000 leave my IRA to charities, and then I'll put $7,000 into my IRA and deduct it. And that way I can indirectly deduct my charitable gifts. So a working senior could contribute $7,000 IRA and then distribute $7,000 that same year to charities and indirectly deduct charitable gifts via their IRA contributions. So they passed this law, but it's overkill. It's not just the same year, it's for the rest of your life. And so people in their 80s and 90s are going to have to keep tax records after age 70, have to figure out what was put in the return. But let me show you ways around this law. Let me first show you an example. So iWorks required distribution this year, next year is $5,000. And every year she gives her required distribution to charity. And every year it would be a qualified charitable distribution. But she's still working. So this year she puts $7,000 into an IRA and deducts it. Next year, she doesn't put anything into her IRA. So as the $5,000 checks made payable to charity leave the IRA, how much can she exclude from her QCD? Remember, she's going to get a 1099-R. You have a $5,000 distribution. How much is a QCD? Well, this year, none of it's a QCD. All $5,000 is taxable because she deducted $7,000 going into her IRA. Next year, when the $5,000 check goes to the charity, $3,000 will be a QCD. $3,000 will be excluded from her income. But the first $2,000 will be taxable. So she'll have $7,000 of taxable income. Now, when this happens, when she makes a distribution for an IRA that's not a QCD, but the money goes to charity, she can take an itemized charitable deduction. But the problem is she doesn't itemize. And so her gifts to charity produce no tax benefit. So what's the way around it? First of all, the lesson is never make a tax-deductible contribution to your IRA after age 7.5. Never. But there's the ways around it. And one of them is, if you have a plan at work like a 401k plan, you can put $7,000 in your 401k plan. The same year, you can roll it over to an IRA and you can make the gift. Also, if your income is low enough, you could have a Roth IRA and you don't get a tax deduction when the money goes in the Roth IRA if your income's under 140,000 single or 208,000 married. And then somebody asked, what about an SEP IRA? Now, what's an SEP IRA? An SEP IRA is if you are self-employed, you can set up your own profit sharing plan. But if you want to keep the costs really low, you use an IRA, but not just a regular IRA. You put $7,000 in. You use an IRA where you can put in like up to $56,000, like a profit sharing plan. It's called the SEP IRA, Simplified Employee Pension IRA. It's only the $7,000 deductions that are a problem for these QCDs. So here's Schedule 1 of the tax return. And this is where you take these tax deductions. And if you look at line 19, that's where you deduct your $7,000 on line 19. But look at line 15, self-employed SEP deduction. And when you put money into your SEP, it is an IRA, but you're not taking your tax deduction on line 19. So the easiest way to remember this is, as long as your client's over the age of 7.5, never report a deduction on line 19. Why is that the solution? Because line 19 is where the Section 219 deduction appears. The SEP deduction is a different statute than Section 219. So as long as there's never a deduction report on line 19 after age 7.5, there will never be a problem excluding QCDs from an IRA from taxable income because you didn't take your deduction that way. And that's how you can get around it, by putting money into your 401k plan, into your 403b plan, doing a rollover, or putting money into an SEP IRA. The one trap with the SEP IRA is that you cannot make a gift from your SEP IRA in the same year that you put a contribution to SEP IRA. But if next year you don't put any money in the SEP IRA, you can make your charitable gifts from that. And to wrap up, though, this isn't as bad a problem as it might think, because a lot of you watching here, you can't put tax deductible dollars into your IRA. Employed upper income taxpayers can't even make tax deductible contributions to the IRA if they're covered by a plan at work, like a 401k plan or 403b plan. So if you are covered by a plan at work and your income is over these levels of 76,000 single or 125,000 married, you can't deduct your contributions that go in. But if you have a friend who has income under those levels, or if they don't have a plan at work, they're self-employed or something like that, then just warn them, don't use the IRA, use these other techniques, because it's going to hurt you with your charitable giving in the future. So the last topic we'll wrap up with here in this brief lunch session, and what I've learned from students is students and people at programs like this are the only class of consumers who want to get a little bit less than they paid for.
Professor Hoyt, before you move on, I think there's one more question about rollover IRA.
Okay, can you read it to me?
It says, if you have done a rollover to an IRA from a 401k plan after age 75, are any contributions to the 401k after age 70 considered in this rule?
No, they're not, because the 401k deduction is section 402 deduction. So it's only a section 219 deduction. And the easiest way to say, what's section 219? That's the $6,000 or $7,000 deduction you can make. So perfectly okay to do a rollover. Same year. So there's loopholes.
Thank you.
Yeah, great. And thank you for that. So can you stretch an inherited IRA with a CRT? What's this word stretch? Stretch IRA and all this other stuff. Well, the term stretch IRA means an inherited retirement plan account, and it's usually an IRA, it's not a 401k plan, where payments are gradually made over the beneficiary's life expectancy, an oversimplified life expectancy, until the enactment of the Secure Act, until about 2020. It was very, very easy for anybody, you, me, anybody, who inherited a retirement plan account to receive distributions from the inherited account until you were 83 years old, because that was the life expectancy everybody had as at least age 83. And if you inherited at an older age, you can take it out till age 85, age 90, and so on. So it used to be, the stretch IRA is fantastic. You could take an inherited account and you could keep it alive and keep tax deferral going till you're 83 years old. But beginning where people die in the year 2020, and we don't have enough time to go through all the rules, the general rule now is that when a person dies, you got to liquidate the account in just 10 years. So you go to a client who's got $1 million IRA. I'll try to make numbers simple and large. Client, you have $1 million IRA. Yeah, I do. And when you die, what's going to happen? Well, after I die, we got to liquidate it within 10 years. Because if I don't, there's a 50% penalty. If I keep in year 11, if there's still money in the IRA, the government takes $500,000, 50%. So let's pick a tax bracket for the kids, 20, 30, 40%. Let's say it's 30%. So I realized that after I die, 10 years after I die, the $1 million is going to shrink to $700,000 because there's going to be $300,000 or $400,000 income tax. You can approach that person and say, you know that $1 million IRA? Yeah. And you know how it's going to be liquidated in 10 years? And you think there's only going to be $600,000 or $700,000 left? Yeah. How would you like it if we could take that $1 million IRA and after you die, the entire $1 million will provide income to your kids, not reduced for taxes, and they'll get a lifetime benefit on all $1 million. Would you like your descendants to be able to get an income stream from all your retirement assets, the whole $1 million, for the rest of your lives? Oh, I'd like that, but you can't do that, can you? Yes, you can. And that's the concept, that the IRA is a tax-exempt trust, but the Cheerleader Trust is a tax-exempt trust. And so we will have the $1 million in your IRA leave in one check to the Cheerleader Trust. And then the IRA is going to tell the Cheerleader Trust, you have $1 million worth of taxable income. Cheerleader Trust says, that's all right. We're a tax-exempt trust as well. Now that $1 million is going to go to charity. But before it does, it will provide an income stream to your kids for the rest of their lives. And let's say they're a 5% payout. They will get $50,000 a year for the rest of their lives. And then the charity will get the $1 million. So with these retirement plan accounts and them being liquidated in just 10 years, donors are kind of likely to consider, if you have $4 or $5 million in it, well, maybe I should give $1 million to charity, make some outright bequests. But the other concept, which we don't have time for, but if I ever get to your beautiful island, we can just go through the checklist of how you do it. Because I have an article on everything checklist, is to name your charitable remainder trust as the beneficiary. The child gets income for more than 10 years, and then it goes to charity. And the secret sauce here, first of all, you all know what a charitable remainder trust is. You make payments to a non-charitable beneficiary, typically for life. You could have a term of years of 5, 10, 15, 20 years, but maximum 20 years. But typically life, the life of your child. Upon the death of your child, the remainder interest goes to charity, but the secret sauce is it's tax exempt. When it gets the $1 million, it won't pay any income tax. And what I'm looking at is one for, I have a spouse, that it goes to a charitable trust that pays an income stream by my spouse. Let's pretend it's $1 million, 50,000 years of my spouse for life. When she dies, it doesn't go to charity. Then the 50,000 a year goes to my kids for life, and then it goes to charity. Now there'll be no federal estate tax deduction, and this is pure income tax planning. And right now, the estate tax deduction threshold is $11.7 million, and so I don't have to worry about that. Now, President Biden, the Ways and Means Committee just proposed lowering it next year to about $6 million, $5 million index for inflation, about $6 million. And Joe Biden has said he might like to see it be at $3.5 million. And Senator Bernie Sanders of Vermont said he'd like to see their threshold be $1.29. But let's say it goes down to $6 million. If you're going to pay the estate tax, this IRA to CRT is not a good strategy. There's a lot of technical reasons for it. But as long as your client is less than $5 or $6 million, then there's no estate tax, and this income tax strategy is good. And that's what I might do. I don't have to worry about the $5 or $6 million threshold. Whew, thank you. My own income tax planning. By the way, I bought Facebook and Amazon the first year they came out, and I sold them both 3 months afterwards for a 6% profit. But anyhow, you might have kept on this stock. So that's the concept. Pay 5% to the surviving spouse for life, 5% to kids for life, then determine it's to charity. And again, the concept is like an IRA, a charitable money trust is a tax-exempt trust. And this can be kind of like a Q-tip trust. I put the stock and the real estate in your normal Q-tip trust, but then I'll use the charitable remainder trust to do for the taxable income, the income of respective decedent, what my Q-tip trust does. One difference from a Q-tip trust, though, the CRT, when you have a spouse and kids, won't qualify for the estate tax marital deduction when I add the kids to that trust. So we don't have time for all the strategies, but that's the strategy number 4 here. Name a tax-exempt charitable remainder trust as the beneficiary. So let's look at the theory, and let's look at when the family will have more money with the charitable remainder trust than if you just give the IRAs outright to the family. So the theory, move income in respect to decedent, the inheritance as taxable income, tax-free after death from one tax-exempt trust, the IRA, to another tax-exempt trust, the charitable remainder trust. Now, you don't want to do this with a charitable lead trust. You don't want to have a charitable lead trust be the beneficiary of an IRA. Why not? Because whereas the charitable remainder trust is exempt from income tax, a charitable lead trust is not. And the $1 million of taxable income will be taxed. So this is a charitable remainder trust arrangement. And the best private letter ruling out there is 1999-01-023, that when the $1 million goes from the IRA to the charitable remainder trust, there's no taxable income to beneficiaries until they actually receive the $50,000 a year from the charitable remainder trust. So can a charitable remainder trust produce more family wealth than an IRA payable in a liquidation? The answer is yes, but usually not. So for the charitable remainder trust to produce more wealth for the family, I need 2 things. I need kind of a long-term trust, at least 30 years. And so if I have children in their 40s and 50s, yeah, that should last for more than 30 or 40 years. The second thing I need for the charitable remainder trust to save taxes is that the income would be taxed at a high rate after death. If it's going to be taxed at a low rate after death, then the CRT doesn't provide that much benefit. So when I have those two things, I think the Cheerleader Trust is going to last for 30, 40, 50 years. And if we left the IRA outright to the family, there would be a high income tax rate. Yes, then the Cheerleader Trust can produce more wealth. Let me give you a real simple example. Let's pretend that we live in a world where every investment you make earns 5%. And we have one family, and the family has an IRA with $1 million in it. But this is no ordinary family. If you know Aesop's fable of the grasshopper and the ant, and the grasshopper fiddled away all the summer and had fun, and the ant was industrious and saving food for the winter. And when the winter came, the grasshopper perished, but the ant survived. Well, this is the grasshopper family. And they know their child, the grasshopper, is going to blow all the money when the child gets it. You know, with the pandemic, a lot of families were forced to be together, and they learned a lot of stuff about each other that they might not have known in close quarters. And the story is about 8 months into the pandemic, one child approached the parents and said, "Was I adopted?" And the mother replied, "Not yet. We just put the ad in the paper yesterday, and so far there have been no responses." So this is that family. This is the grasshopper family. And they know their kid's going to blow all the money. So they say, we need a spendthrift trust. When we die, our $1 million IRA is payable to a spendthrift trust where our grasshopper child cannot get the principal. So trusts have the worst income tax rates. You're in the 37% bracket with just $13,000. So I have that part of the equation, right? I have high income tax rates after death. Anytime an IRA is payable to a trust and the trust is going to keep that money, you're paying the worst income tax rates. Well, anyhow, at least after taxes, there's $600,000. There's our spendthrift grandchild cannot waste, and the spendthrift grandchild will have income from that $600,000. Now, there's another family, the ant family, and they also have a $1 million IRA, but they're going to name a charitable remainder unit trust for their child, the ant. So upon their death, the $1 million goes from the IRA to the charitable unit trust. And then upon the death of the ant or the grasshopper, the charity will get all $1 million. There's no $400,000 of income tax paid. The grasshopper family, the descendants of the grasshopper, will then get the trust that has $600,000 in it. So the first thing we see is that the charitable trust can produce more investment income than the spendthrift trust. Spendthrift trust only has $600,000 to invest and earn 5%, which is $30,000 a year. The charitable trust can make the same 5% investments, but it has $50,000 a year of income because it never paid the $400,000 of income tax. So now the ant, though, feels a little bit guilty. The ant says, you know, when I die, the charity will get the $1 million, which is fine, but my children won't get any of this. Compared to the grasshopper's family, will get the $30,000 a year from the spendthrift trust. So I want to take care of my descendants. And what I'm going to do is I'm going to just spend the same $30,000 that the grasshopper does. I'm going to take my $50,000. I'll spend 30 like the grasshopper, but then I'll take the other $20,000 and save it. And that's the bottom line. Will the extra investment income from the Cheerleader Trust be able to produce enough wealth that you can replace these $600,000 that would otherwise go to them if we didn't have a Cheerleader Trust? Now, the 20,000 years taxable income, if the ant is in the highest tax rate of 40%, then we'd have 12,000 a year to save. And the question is, over how many years would it take for the $12,000 to grow to the $600,000 so that the ant's descendants would have $600,000? And if you earn 0% of your money, 50 times 12 is 600. But you don't earn yours. And now for my English-speaking friends, you don't earn 0%, you earn 5, and you can do it in 30 years. And then you can do it in shorter time period. And also, to protect the ant's descendants, what if the ant dies 1 or 2 years after the parents die? I might want to take the $12,000 a year and buy some life insurance, the old wealth replacement plan. And now I know that if the aunt dies at any point in time, there's $600,000 to replace the money that otherwise goes to the charity. So there you have it. If you have a high tax rate, 40%, you have a long-term trust, 30 years or more, the Cheerleader Trust can produce more wealth than leaving the IRA outright to the Spendthrift Trust. But change something. What if there's a low tax rate, 20%? We're going to leave it outright to a school teacher in Texas that has no state income tax. And the school teacher is just in a 20% tax bracket. Well, now you'd have $800,000 instead of $600,000. And now you can see the Cheerleader Trust doesn't produce that much more investment income than if you left the money to a Spendthrift Trust or to the child outright. And so if we try to do the same math and you have an extra $8,000 a year, how long would it take for the $8,000 to grow to $800,000? The math doesn't work. So again, what really works is where I have a high tax rate after death, which will happen 100% of the time, that you leave the assets to a trust and the trust pays the income tax. As opposed to if the trust just passes it through the beneficiary and then the beneficiary pays the income tax. And second, I have a trust that lasts 30 or more years. The main feature I want to share with you, though, is that this is not just a gimmick. You shouldn't just force this on people. The question is, does the CRT need to be established prior to passing or simply name the beneficiary established after that date? I think you can have a CRT in the will, and you just sign a trust instrument to the CRT dated September 23rd, 2021. Doesn't have to have any assets, and the money can go to that. But you want to draft the CRT instrument in advance. I would like to probably have a separate CRT with a date on it, and then the instruction is paid to that CRT. But it's best for people with someone's charitable intent who also wants to benefit the family. The best person is someone who says, if my child dies a year or two after the $1 million goes to the CRT and the charity gets the money right away, I'm okay with that. That's the best person. But if you say, well, you should have a CRT, well, which charity should I name? And we can go into that in more detail later. But that's the big picture. There's a 60-minute lecture on tax smart charitable giving, especially with retirement assets. And let me turn it over to Janelle and Jennifer. And thank you for taking time from your busy schedules to participate today. Mahalo and aloha.
Thank you, Professor Hoyt. We just, you always make learning fun. So appreciate your jokes in between as well. Just to remind everyone, we will send you an email of the recording, Professor Hoyt's PowerPoint slides, as well as I think it's a 38-page white paper about the information today. So mahalo. Thank you, everyone. Jennifer.
Yeah, I just wanted to thank Janelle with Hoyt Community Foundation, as well as Professor Hoyt, both of them, for coordinating and presenting today to our members. And just thank you to everybody for joining us.
Thank
Aloha.
you. Mahalo. Mahalo and aloha.